So if you're watching this video, you are basically from the previous video where we launched the trading indicator. So in this video, I'm explaining how the indicator works, basically based on moving averages, average trend, and the relative strength index. So if you want to take it further, you can also incorporate Fibonacci retracements, Chinook cloud, and Bollinger Bands. That will even make it better, but I'm going to explain that in a few. Now let's look at moving averages. So moving averages, as you can see on your screen, we have three, but in essence we have four, but I'm going to touch on three. That's a simple moving average, exponential moving average, and weighted moving averages. So simple moving averages and also the exponential moving averages, basically the optimal settings for them are the same. That's a 50 period moving average to capture short time trends. For medium term trends, you can use 100 or 200. And for long term trends, you can use 200 moving average. So, but the only difference is that on the exponential moving average, on the short term trends, you can also opt to use 21 period. But for weighted moving averages, for medium term trends, you want to use the 50 period. And then for short term trends, you want to use the 30 period and the 50 period. But across all moving averages, for the long term trends, you want to use the 200 moving averages. I'll touch on them in intensity in another video, whereby you can use the moving averages to confirm trends. You also use them to signify you when to have those entries. So there are certain strategies such as that if the short-term moving average crosses above the medium-term moving average and both are sloping upwards, that will indicate a strong bullish signal. So those are one of the logical things that I've put in the indicator. You can also use the moving averages to filter signals, and then you can incorporate them with the other indicators, and also they are very good at risk management. Now, we look at relative strength index. So this is a momentum oscillator that measures the speed of change of price movement. So it's used to assess potential trend reversals, also and continuation of trends. So for RSI, the optimal period is 14. And also for identifying overbought and oversold conditions, you can use the traditional levels, which are 70 for overbought and 30 for oversold. However, in volatile markets like gold, you might consider using 80 for overbought and 20 for oversold. That's to avoid premature signals. So the relative strength indicator is used to confirm where together with price action to confirm trends to, and also it can be helpful to help you to avoid overtrading. Now for the final one, we have average true range. So this is a technical indicator that measures the market volatility. So I'm not going to dive into how it does that, but you can find it on your trading view if you want to look at it. So the optimal period is 14, but on a higher time frame like daily time frame, you can opt to use 21 or 20, which captures broader market volatility. So the way ATR is used is that it's used to set stop loss and take profit levels. So this can be based on multiples of ATR, or you can use also key potential support and resistance levels. So can also be helpful in position sizing and also to confirm trends. So based on these indicators, that's how I came up together to piece it into one indicator that's used to provide signals essentially. So that's how it works.